I'm delighted to be speaking to you today about the Merchants Trust and how we invest in the UK equity market. Just before I start, there is a disclaimer. Please take note of the comments on this screen. The Merchants Trust is an investment company that invests in the UK equities market. We're trying to deliver a high and rising dividend stream as well as good total return. By investing in UK companies, we think we get a good combination of high standards of corporate governance, high standards of stewardship, but also exposure to industries around the world, because about 3/4 of the profits and sales of UK businesses come from abroad. The Merchants Trust has a very high dividend yield, about 6.5%, one of the highest yields in its sector, and the dividend has grown every year for 38 years, and that remains a really important objective for the company and for the directors. And it's backed by significant investment revenue reserves, which I'll talk about later. We have a strong performance track record based on an active portfolio. And by active, I mean not just that we take strong views, high conviction positions, but we also do move that portfolio around depending on where we see value at any time. And we have a value-driven approach, which means we focus a lot on the price we pay for assets. And the third key point is we have a low management fee, one of the lowest in the sector, and a strong independent board of directors who are there to look after the shareholders in particular. They work for you on behalf of the shareholders. As I said, the trust has a history of raising the dividend every year for 38 years. And the reason that investment companies can do this is because in the good years, we can squirrel away money into the reserves. So for example, you can see on this page that going into the financial crisis, the directors put away a lot of money into dividend reserves, the green bars here, and then they drew on those reserves to keep growing the dividend every year after in 2010 and 2011. And really what you'll also see on this chart is for the last 2 or 3 years before this year, we've been putting significant money back into reserves to build those buffers up for a rainy day. And at the end of the last financial year, there was 28 pence or about a full year's dividend in reserves. And this year we are going to be drawing on those reserves because the dividends have been cut in the market. We're seeing a lower level of income coming in, and the directors have made it clear that they're prepared to use those reserves to continue to support the dividend policy. If we then look at a few key facets of Merchants Trust, we have around about £620 million in total assets, £94 million of debt, so net assets of around about £530 million, and gearing of about 18%. The shares are trading very close to the asset value, the NAV, a very small premium as at the 20th of November, and the yield, as I said earlier, is 6.5%. So those are some of the key numbers of the Merchants Trust. The UK equity team running the money, there's 3 of us working very closely together, myself, and I've got over 32 years experience. Richard Knight and Matthew Tillett work with me, and we work together to choose the stocks for the Merchants Trust. But we are surrounded within our company by a lot of other people, a lot of other investment professionals, fundamental analysts looking at companies, portfolio managers also looking at businesses and companies around the world. We've got our own ESG team looking at environmental, social, and governance factors, which are really important. We have a macroeconomics and strategy team, a credit research team, so that we're not just looking at the equity value of a business, but we're also considering the debt in the business and the issues there. And we have something I think is unique amongst fund managers. We have our own market research company called Grassroots, so we can go out and look at individual products and services that companies produce and provide, and we can ask in the marketplace how those services or products are perceived, and we can get an independent view from the management of the company into how well their products or services are performing and are positioned. And that really gives us a great advantage when we come to look at individual companies and their prospects. Our investment process, stock selection process, starts by looking at 3 things really. We're trying ultimately to buy sound companies with a strong fundamental position, an attractive valuation, and in a supportive environment. What do I mean by strong fundamentals is that we look for a company which has a strong market position in an industry, a strong competitive position, has a robust financial position, and it has a combination of environmental, social and governance factors which are supported. So for example, we look at the board of directors, we look at how the management are incentivized. We want to make sure the company has not got a bad record or a big risk on the environmental side and so on. So all of that goes together, building a picture of the company. We look at the valuation. We look for companies that are cheap compared to their history or cheap compared to other companies we can buy in the market. And we look at dividend yield, and I'll come back to that in a minute. And then the third thing we look at is we're very conscious of trying to buy companies that are cheap but are not structurally challenged. So we try and understand the structural pressures, the structural changes going on in an industry, and ideally buy companies that are well positioned for structural changes and possibly for cyclical changes as well. For example, if the construction industry is recovering, that's a better environment, a better outlook than if we're going into a downturn for that industry. So put that together, we'd like to buy strong companies that are cheap, that have a supportive macroeconomic or a supportive thematic background. When a company is fully valued, we will sell it. If the investment case changes, we'll review it very closely and we might sell it. And if there are better opportunities elsewhere, then we may sell it. Coming back to yield, dividends are really important. We're trying to buy high yielding companies, and we target companies with a yield in line with the market or above, either today or within 18 months. One of the reasons for doing this is historically buying high yielding shares has been a very profitable place to invest. If you look at the chart we show here, if you put £1 into the stock market in 1900, after 120 years or so, your pound, 118 years, your pound would have grown to £37,000 reinvesting all the dividends. If, however, instead of buying the top 100 companies, you bought the 50 companies with the highest dividend yield each year and then reinvested in the 50 the next year, your pound would have grown to £161,000. So by buying high yielding shares, historically, you would have delivered a better return. And we think there's a good reason for that factor to continue, but not every high yielding share is attractive. In fact, you've got to be really selective because there are many value traps. So we try and buy high yielding companies, but the yield alone does not drive the investment decision. We only buy companies we think can make us a good total return for the reasons I've touched on, the type of things we look for before. And we don't automatically sell a company if the yield drops below a certain level. For example, if a company cuts a dividend, and we've seen a number of those this year, so we don't automatically sell a company just because they cut the dividend. So that's the other side of our investment process. We're looking for good companies, but we're looking for companies with a decent yield as well to drive the income. To give one example of a company we've added this year, Next is a well-known retailer. It's got an interesting history. It's been moving from store-based sales, particularly in women's fashion, towards a much broader offering, online in particular, which is growing fast. Also credit and finance is a big part of what they do. And they've been moving away from clothing towards home, towards children's wear, and more to international. And you can see on the chart we show in front of you that the contribution from stores is now declining, but the contribution online is growing very fast. And the company has gone past an inflection point where the growth of online is offsetting the shrinkage of the store base. Company has, on the fundamentals, the company has an exceptional record. It's got a high return on capital and a very strong record of allocating capital. The valuation during the summer was depressed. We were able to buy the company at a very sensible price, given its long-term prospects, when the stock market was quite depressed. And thematically, it's benefiting from the growth in online. It's benefiting from the ability to offer other retailers a way to get onto the internet if they don't have the capabilities themselves. And it's got declining lease costs, which are helping the profitability. The one negative on the thematic side, of course, is they do have stores, and stores are more challenged today than they have been. But it's a great company, and it's nice to be able to buy it this year at a sensible price. So what's been happening this year? It's been a really challenging year, clearly because of the coronavirus pandemic. We've had the sharpest ever recorded drop in gross domestic product, around about 20% in the second quarter of the year. But we are seeing a rapid recovery and huge government support to individuals, to companies, and so on. We saw 9 million people on furlough at one point. And whilst there remains uncertainty about the outlook, about unemployment, and what's to come down the road, the outlook is improving as we speak. But this government support, low interest rates and so on have distorted financial markets. We've seen very low interest rates, and we've seen a real stretch, a real bifurcation in the market between what might be called value shares and some of the higher growth, higher quality shares, which have moved to really high premiums. Quite an unusual polarization. I'll come back to that theme. What we're seeing more recently is that the companies that were last to shut down, such as house builders or some of the retailers, have recovered quite quickly in some cases. And we are seeing a strong recovery in housing activity, in DIY, furniture, car sales, even advertising is picking up quite quickly. Whereas other activities which were early to shut down, like airlines, flights, aviation, leisure, those areas remain pretty depressed and aren't recovering very much yet. We're also seeing certain structural shifts accelerate, such as the shift to working at home or the shift to online shopping. And it remains an open question how much that progresses going forward. But we will see life in the future being different to life in the past in some industries. On the more positive side, companies have acted quickly to protect their finances, to improve their balance sheets. We've seen many businesses raise money. We've seen dividend cuts which have preserved financial stability. And if anything, companies are coming out of the downturn in a stronger financial position than we thought they might be a few months ago. There are risks from the second wave of the pandemic. We are seeing further lockdowns, not as bad as the first one, but offsetting that, there are hopes now for vaccines. In fact, we've obviously had some very positive vaccine news in the last few days. There are hopes for better treatment, track and trace, which could limit the damage going forward from the pandemic. And we are finally starting to see companies reinstating dividends, restarting dividends, or at least talking about that in many cases, and probably more than we would have thought a few months ago, quicker than we would have thought. As I said earlier, the market is very polarized. There's two big themes in the UK at the moment. Firstly, the UK stock market is much cheaper than other markets, and the valuation discount is at a sort of 30-40 year low if you look at the UK compared to Europe on the left-hand side of this page. The other big theme is that within the market, you've got a big polarization between value and growth or value and quality, and higher price shares are trading at a very high premium. Now, clearly good companies should always trade at a premium to weaker companies, but that premium has become really quite extended until the end of last month at least. And so those two themes are also guiding what we're doing and how we're thinking about investment. So what have we done this year? Well, we have firstly maintained our approach, our value-orientated philosophy and process. We haven't changed that. We continue to look to buy strong companies with high dividend yields that are attractively priced. I mentioned Next, but we've also added businesses like Close Brothers, which is a very strong bank, a specialist lender. We've added Royal Sun Allianz Insurance, RSA Insurance. So we've added good businesses taking advantage of the volatility in the market. We've also added to some of the more defensive companies. Clearly, we are in a difficult economic environment. We were not expecting a difficult environment this year when we came into the year, because we just had a new government with a strong mandate, and we thought we were going to have a better economy. So we came into the market with a slight cyclical bias. We've been reversing that and taking a few more defensive positions, such as telecoms, adding to tobacco and so on. And we've been adding to safer income producers across the portfolio, but also areas like telecoms and tobacco and oil and gas. So we've been adding to the income generation in the portfolio. We've exited a few of the cyclical positions where we could still exit at a sensible price. And we've also taken a view on one or two companies where we think their business model might be more challenged going forwards than it has been in the past. And one example, for example, is Informa, which is an exhibitions company. People are getting used to doing things virtually, like its conference today. And the idea, fewer people might go to exhibitions and conferences in the future, and therefore, at the very least, there's a question mark about the growth rate and growth outlook for that type of business. So we've been trying to focus on businesses that we think are more resilient structurally to the challenges. When I look across the overall portfolio, and this data was put together at the end of October, and the markets are moving incredibly fast, but this gives a really interesting picture. At the end of October, if you break down the stock market in the red bars here into different bands of price earnings ratio, then about 15% of the market on the right hand side, for example, is on a price earnings ratio of over 24, a very high rating. And in fact, a third of the market, 30% of the market, is on a rating of 18 times or more, whereas also there's a big chunk of shares on a low valuation. So you have this odd bifurcation, polarization of the market, where there's some companies that are highly rated and many others that are lowly rated. We don't really want to own too many companies that are expensive and highly rated. We find some great opportunities in the lower rated areas of the market. So our portfolio in the blue bars, you will see, is very heavily biased to lowly priced companies. That was at the beginning of the month. And that, I think, is an unusually wide difference between where we are positioned and where the market is positioned. And that's just reflecting the strength of the opportunities and how depressed some UK companies' valuations really are. But we're not buying weak companies. I mean, a lot of people look at that and say, well, you're buying lowly rated companies. Are you buying weak businesses or structurally challenged businesses? And we were pushed back quite hard on that. If you look at some of the companies in our portfolio, some of the companies in the UK, there are many world-leading companies on modest valuations. I mean, we own companies like GlaxoSmithKline, which is the leading consumer health business in the world and a very strong vaccines business. IG Group is one of the leading spread betting businesses and financial trading companies. Keller is a leader in geotechnical engineering or piling, you might want to call it. They've got a big position in America. It's a very fragmented market. So there's a number of companies in the UK that are genuine world leaders and actually are not trading on particularly high valuations. So it's a really exciting time to be a stock picker in the UK market. The income aspect of merchants is really important. It's critical. It's a key objective of the trust. And we are seeing in the market many dividend cuts, probably more than definitely more than I can remember in my career. Some of that is permanent. Some of that is a rebasing of dividend cuts, such as in the energy sector. Now, the good thing is we started with a dividend that was well covered last year, 110% covered by earnings. And we do have, as I said earlier, about a year's dividend in reserves, or we had that at the end of last year. And we're adding to more high yielding companies. We're doing an element of covered call overwriting, which adds more income. And our portfolio is diversified by industry. And some of those areas like tobacco, like pharmaceuticals, some of those areas are more resilient in terms of the income they're producing. And if you look at our top 10 income producers or top 10 holdings, 9 of them are still paying very good dividend at the moment, and only one of them is not paying a dividend this year. So it's not by all means it's not universally a difficult picture, but clearly there are strains on the income that we're getting this year. But we do expect the income to build pretty quickly next year, and then again in the following year as companies return to paying more normal dividends. Final thing is we are seeing dividends return already. Companies like BAE Systems, Keller have reinstated 2019 dividends, and other companies like WPP have reinstated their interim dividend or introduced dividends again. In terms of performance, the second objective we have, as well as delivering income, is delivering a total return. We show on this chart, the first chart at the top is the long-term net asset value of Merchants Trust and the share price compared to the benchmark, which was the FTSE 100 until the beginning of 2017, and then it's been the FTSE All Share since then. And up until recently, we were well ahead of the benchmark. This year was difficult. When the market fell, our portfolio got hit quite hard, and the gearing meant that the NAV performance moved back to sort of in line with the benchmark to the end of October. The underlying equity portfolio has actually done very well over 10 years, despite having a value bias, which has been difficult. But more recently, performance has been extremely strong. So the chart on the bottom shows the first 20 days in November, and our performance is something like 10% ahead of the market in that period when the market has gone up quite a lot as well. So we have regained a lot of the performance that we lost earlier in the year. So the underlying portfolio performance has been good. The gearing of the investment trust, the borrowing, does mean that in the short term, the performance can be either positively or negatively affected by sharp movements in the market. But over the long term, we've done well. As I said, we do have gearing. The way the debt is structured is we have about 93 million of long-term debt, or it includes we've got a revolving credit facility now. But if you go back to 2017, or 2016 calendar year, we had about 111 million of debt taken out a very long time ago at a really high interest rate. So the company was paying 8.5% on its debt at that time. Through a process of restructuring, and I won't go through all the details, we've brought that cost of debt down by more than half. So the average cost of debt is about 3.75% now. And the gearing has also come down. We brought the gearing down at the beginning of this year to 15% or 93 million pounds of debt. The gearing as of today is around about 17-18% because markets have gone down and so the gearing has gone up, but it's still below where it was a year ago or 2 years ago. And the cost of debt is significantly lower. So just to round up and just to summarize, Merchants Trust has one of the highest yields in the market, in the sector, about 6.5%. We have grown the dividend every year for 38 years, and there are significant reserves in the company to support that dividend strategy. We have a strong performance track record based on an active, high conviction portfolio that I think you can see from what I've been saying is very different to the benchmark. We are taking some strong views and prepared to move that portfolio around with a value-driven process behind that. We have a modest management fee of 0.35% of gross assets and an experienced and diverse board of directors who are there to work on behalf of the shareholders. So thank you very much, and thank you for spending time with us today.